Welcome back, traders. US tariffs are here to stay. Even though federal court suspended reciprocal tariffs last week, President Trump proved that he has enough tools to fight against his global trade partners by doubling tariffs on steel and aluminum during the weekend to 50%. Well, the tariffs will take effect on June 4th, Wednesday, unless President Trump decides to postpone them. Meanwhile, tensions with China seem to be rising as well, with Beijing threatening to take stronger measures to defend its national interests after blaming Washington for severely violating their trade truce. But the trade drama will not be the only catalyst moving markets this week. The US calendar has plenty of data releases, including the US ISM business PMI figures and Friday's nonfarm payrolls report. Meanwhile, a speech by Fed Chairman Jay Powell might cause some market movement today following his meeting with President Trump last week. It will be interesting to see whether the Fed Chairman is still interested to resist against Trump's calls for more rate cuts. And so on the central bank front, the ECB and the Bank of Canada will be announcing their rate decisions on Thursday and Wednesday respectively. So it will be overall a wild start to summer's trading session, particularly for FX pairs such as euro-dollar, dollar-yen, and dollar-loonie. So starting first with the ECB rate decision and euro-dollar, while the central bank is expected to cut interest rates by 25 basis points. Overall, the Eurozone economy started the year on the right foot. It showed some recovery, but that was mainly because of businesses front-loading their orders in fears of potential higher import tariffs. The latest business PMI figures suggested that, they basically came weaker than expected, questioning whether the expansion in the first quarter is sustainable. So that could justify another rate cut this week, especially if CPI inflation figures also slow down, as forecasts suggest. Specifically, the headline CPI figure is expected to fall to 2%, meeting central bank's inflation target. So that could allow policymakers to vote for another rate cut. However, whether the rate cut cycle will continue in the coming months, this remains to be seen. Policymakers didn't sound very promising during the previous days, so it will be interesting to see whether the central bank may adopt a more hawkish tone, whether it will signal that interest rates have already reached the neutral territory. If they do so, euro-dollar could spike higher, and in this case, I would like to see close above the 1.1485 or 1.1512 territory in order to target the next barrier seen near 1.1670 and 1.1750. That area over here includes a couple of important resistance lines, so I would pay attention to these before moving up to meet the 161.8% Fibonacci extension of this downfall at 1.1885, and even higher, the next barrier could pop up somewhere between 1.20 and 1.2070. As we can see from the chart, this area over here includes this tentative resistance line coming from May 2024. If you look at the technical indicators, we can say that the short-term bias is still positive. The RSI is still above its 50 neutral mark. The stochastic oscillator has turned up, and the MACD is showing some progress above its red signal line. So perhaps upside pressures could persist as long as the price holds above its supportive 20-day moving average at 1.1270. Now, in the event the price reverses to the downside, perhaps in the case the central bank uses sounds more cautious about the Eurozone economy, that could drive the price lower. And if the 50-day moving average at 1.12 fails to hold as well, then we could see a more aggressive decline towards the 1.10 territory. That would violate this upward trajectory and therefore increase negative risks, especially if the price also closes below this tentative support trend line from February at 1.0933. In this case, we could see a bearish continuation towards the 200-day moving average. Now looking at dollar yen and the non-farm payrolls report, analysts are still keeping the bar low. They're expecting a slowdown in jobs growth to 130,000 from 177,000 previously. The unemployment rate could remain steady and average hourly earnings could ease marginally. So overall, if forecasts are correct, the report may indicate weakness in the labor market, and if the data come worse than expected, that could cause a strong bearish reaction in dollar yen, especially if Fed chairman also signals more rate cuts ahead. That could drive the price below the 142.40, 142.75 support trend line zone, and towards the next pivot area of 140.40, 140.90, where the price managed to pivot back in April. If that area proves easy to break, if this support collapses, then this downward trajectory could gain more legs, and in this case, the next stop could emerge near the 138.90. This region includes this tentative support trend line drawn from December 2023. Now, if the central bank sounds more hawkish, if Powell suggests that rate cuts are not necessary in the time being, that could provide some support to the US dollar, and perhaps dollar yen could rise up to retest the 144.40, 144.90 resistance zone, which includes the 50% Fibonacci retracement of the 2023 and 2024 up leg at 100. If we move even higher, then the 146.20 zone could be a tougher barrier. This is where this tentative resistance line from January 2025 is placed. So a break above this zone could be symbolic. That could increase hopes for bullish continuation towards the 200-day exponential moving average and the 38.2% Fibonacci of 148.63. Well, if we look at the technical signals, though, it seems that the short-term risk is skewed more to the downside than to the upside. All the indicators are sloping downwards, and the MACD is still within the negative zone, so bearish pressures could probably persist in this market. And finally, looking at dollar loonie, well, the Bank of Canada is expected to hold rates stable for the third consecutive meeting. The economy also showed some recovery in the first quarter, but again, this was driven by higher exports and higher and perhaps more business activities as tariffs threaten higher import costs. That's not a sustainable catalyst for economic growth. So the central bank may remain cautious about the economy as the unemployment rate is near to peak above 7%. Perhaps labor data could provide more updates about the labor market in the coming days. Overall, that may keep policymakers cautious. Nevertheless, it seems that the weakness in the US dollar is adding pressure on this pair. So the loonie is strengthening and is near the next barrier near 1.3640. This includes this tentative support trend line from December 2023. So if that area fails to hold, we could see bearish continuation for the US dollar towards the 1.3545 zone, where this tentative support line is placed. While even lower, there's another pivot point, an important pivot point, where the tentative support trend line from July 2024 is placed near 1.34 and 1.3420. As we can see, that was a key pivot point last year, so definitely it will be closely watched, especially as the technical signals down here suggest that more weakness could follow in this market. And as we can see, there is also a death cross created in this pair between the 50 and 200-day exponential moving averages, suggesting that the negative trajectory could gain more legs. Now, if the central bank sounds more dovish, or if the US data surprised to the upside, we could see some recovery in this market. But the bulls should try harder to change the outlook. First, they will need to overcome the 1.3838 zone where the 20-day EMA is placed. Then above that, the 50 and 200-day EMAs should be also overcome at 1.3940 and 1.40 before all the attention turns to the 1.4090 zone, as this is where this tentative resistance trend line drawn from March 2025 is placed. So any break higher would could resume positive outlook. And so that's everything I wanted to share with you guys. It will be a very busy week in terms of central bank meetings and data releases, as well as headlines about the global trade war. So stay tuned, and don't forget to use don't forget to look at the headlines for more insights. So that's everything I wanted to share with you guys. Thank you for watching, and see you next time. Bye bye for now.